The market is at a fascinating crossroads. After years of whipsaw moves, from the euphoric melt-up of 2019 to the pandemic-driven chaos of 2020, the record-breaking highs of 2021, and the painful drawdowns of 2022, investors are now navigating a market that feels very different. Economic data tells the story. Corporate America is cautious. The ISM Manufacturing Index hasn't been above 50 for 29 straight months, the longest stretch in history, and yet, equity markets are pushing toward record levels. This isn't the frenzy of a late-stage bull run. The evidence suggests we're in a mid-cycle expansion where selective optimism, not blind euphoria, is driving capital flows. Supporting this view is Tom Lee, head of research at Fundstrat, a strategist who's been right more often than not when he's stayed bullish through volatility. Lee points out that there's $7 trillion in cash still sitting on the sidelines, a stark contrast to the leveraged exuberance seen before prior market tops. He also reminds us that U.S. corporations remain unmatched globally. 21 of the 25 most profitable companies in the world are American, with Microsoft and Meta alone now worth as much as the entire Tokyo Stock Exchange. This is not just market hype, it's a reflection of superior earnings growth, relentless innovation, and leadership in AI, digital assets, and financial technology. As Lee puts it, today's conditions don't resemble a frothy top. They're laying the groundwork for sustained upside. And in this mid-cycle phase, select tech giants are perfectly positioned to lead. 3 of them just reported earnings, and their results align squarely with Lee's bullish thesis, making them must-watch opportunities for any serious investor right now. Let's begin with Alphabet Inc., ticker symbol GOOGL, the powerhouse behind Google, YouTube, and a rapidly growing cloud empire. In a market where select tech leaders are setting the pace for this mid-cycle expansion, Alphabet continues to prove why it belongs in that elite category. The company's second quarter performance this year was nothing short of remarkable. Revenue surged nearly 14% year-over-year to over $96 billion, while net income jumped to $28.2 billion. This isn't just incremental growth, it's evidence of a business firing on all cylinders in both its core operations and its newer, high-potential ventures. Google Services, the engine that drives search, YouTube ads, and a vast advertising network, remains a profit machine with operating margins around 40%. The sheer scale of Alphabet's ad business is unparalleled, benefiting from rising mobile usage, improved ad delivery formats, and advertiser demand that shows no sign of slowing. YouTube alone continues to thrive as a dominant digital video platform, capturing both brand and direct response advertising dollars. But perhaps the most compelling growth story lies in Google Cloud, now generating over $13.6 billion in quarterly revenue, up more than 31% from last year. Google Cloud is not only expanding at an impressive clip, but also seeing margins accelerate sharply. As enterprises worldwide push further into digital transformation, the global cloud market is projected to soar to $2 trillion by 2030, and Alphabet's massive investment in AI-driven cloud services and new data centers positions it perfectly to capture that upside. Layer on Alphabet's strategic bets in AI, from its Gemini large language model to its stake in Anthropic, and the long-term picture becomes even more attractive. In an environment where investors are seeking durable growth leaders with real earnings power, Alphabet stands out as both a defensive giant and an innovation leader. This is exactly the kind of tech titan Tom Lee sees as essential to driving the next leg of this market's rally, and it's why Alphabet remains a must-watch in any serious growth portfolio. Next up is SoFi Technologies Inc., ticker symbol SOFI, a company that's rapidly transforming from a fast-growing fintech into a diversified financial powerhouse, and its latest quarterly results make a compelling case that this evolution is accelerating. In the second quarter of 2025, SoFi delivered a clean double beat, with earnings per share of $0.08 versus expectations of $0.06 and revenue of $858 million, ahead of estimates by more than $53 million. That 44% year-over-year revenue growth didn't just happen by chance, it's the product of a deliberate shift toward high-margin fee-based income streams that are less dependent on interest rate swings and more scalable over time. SoFi's financial services segment now accounts for about 40% of total revenue, up from just 2% 5 years ago. This part of the business, which includes checking and savings, credit cards, and a rapidly expanding investment platform, is showing powerful margin expansion, rising from 31% last year to 52% today. Lending remains the company's profit engine, generating the largest absolute contribution, but the diversification into fee-based revenue creates a stronger, more resilient resilient business model. That means SoFi can grow even in choppier macro conditions, and with its net charge-off ratios trending lower, the company's credit portfolio looks healthy and well managed. The real kicker? SoFi is re-entering the crypto market and preparing to launch stablecoin services within the next 2 years. About 30% of SoFi's existing members already hold crypto, giving the company a ready-made customer base for these new offerings. Stablecoins could open up entirely new revenue channels, particularly by eliminating currency conversion fees in cross-border transactions, a move with massive potential in the digital payments economy. Management's confidence shows in its raised full-year guidance, now calling for $3.37 billion in revenue and $370 million in net income. In a world where fintech competition is fierce, SoFi is carving out a differentiated path, blending traditional lending profitability with the growth vectors of crypto, stablecoins, and fee-driven services. This is exactly the kind of innovative, high-growth player Tom Lee's mid-cycle thesis favors, and it's one worth watching closely as the next phase of the fintech revolution unfolds. Finally, we turn to Amazon.com Inc., ticker symbol AMZN, a company that continues to redefine what a global technology and commerce leader looks like. Q2 2025 was almost flawless by the numbers. Revenue surged to $167.7 billion, beating estimates by a wide margin, while EPS came in at $1.68 versus the $1.33 expected. Yet, the market fixated on slightly conservative Q3 operating income guidance and punished the stock in after-hours trading. In reality, this pullback looks more like a short-term overreaction than a reflection of Amazon's fundamentals, which are moving decisively in the right direction. Amazon's North America and international retail segments are both showing strong double-digit growth and expanding margins, even without the seasonal boost of Q4. Advertising, subscription services, and third-party seller revenue are driving a richer, higher-margin revenue mix. AWS, while facing some near-term margin pressure due to heavy investment in AI and infrastructure, remains one of the most dominant cloud platforms in the world, perfectly positioned to ride the multi-trillion-dollar AI and cloud transformation over the next decade. These investments in custom silicon, generative AI tools, and efficiency-driven networking are designed to lock in long-term leadership, not just in cloud, but across Amazon's vast ecosystem. Innovation is everywhere inside Amazon right now. The company is scaling robotics to unprecedented levels, with more than 1 million robots deployed and new AI-powered systems like Vulkan enhancing warehouse efficiency through advanced power-of-touch capabilities. Prime Video is expanding its audience reach with live sports like NASCAR, Project Kuiper is advancing toward global satellite internet coverage, and the company continues to accelerate same-day and next-day delivery to more customers. The bigger picture here is that Amazon isn't standing still. It's laying the groundwork to capture value from multiple secular growth trends at once. This is exactly the type of diversified, innovation-driven giant that Tom Lee's mid-cycle bullish thesis applies to. A company with dominant market positions, the ability to expand margins, and the vision to keep creating optionality for future growth. If the market is misreading this quarter as anything less than a win, that may be one of the better opportunities patient investors will get to build a position in one of the most transformative companies of our time.